big debt crises. These seem to be, well, a recurring feature of history, don't they?
Absolutely.
From ancient Rome right up to the 2008 financial crisis.
Yeah.
These big periods where debt just goes bad, they really shake things up.
Yeah.
Economies, individuals.
Yeah, they hit hard.
And you're listening because you want to get a handle on these patterns, right?
Yeah.
Understand the key principles so you can maybe navigate things a bit better now and, looking ahead.
And what's really striking is the work Ray Dalio did. He looked at centuries of this stuff, not just recent history.
Right. Across the globe, too. It wasn't just like the U.S. or Europe.
Exactly. Everything from, the Dutch tulip mania way back when to Latin American crises, the Great Depression, 2008. This huge historical perspective lets him see these repeating patterns, these principles.
That's the key, isn't it?
Yeah.
This isn't just a history lesson. We're using his book, Principles for Navigating Big Debt Crises, sort of as our guide today. The idea is to pull out the insights that can actually help, people making decisions, investors, savers, maybe people running businesses. How can this history inform better choices now?
And Dalio himself, he lived through several major crises, so it's not just academic for him. It's grounded in real-world experience, too. You can see how his own kind of caution about debt probably shaped his thinking.
Makes sense.
Yeah.
So let's get to the core of it. What actually causes these big crises? What's the basic mechanism?
Well, it usually starts looking pretty good. You get more lending, which fuels more spending, more investment.
Okay.
And that pushes up incomes, pushes up asset prices. It feels like a positive feedback loop.
Everyone's happy. Things are booming.
Exactly. And that encourages even more borrowing and spending. But here's the catch.
There's always a catch.
The catch is that this growth, fueled by debt, often starts to run way ahead of the real economy, the actual productivity gains. Eventually, the amount of debt, and crucially, the cost to service that debt, the interest payments, it just gets too big compared to the income being generated.
So people and companies are stretched too thin.
Right. And near the peak, you often see lending happening based on, frankly, unrealistic ideas that the super fast growth we just saw is going to continue indefinitely.
Which it rarely does.
Which it rarely does. And that's when you start seeing bubbles form, fueled by optimism, sometimes some pretty reckless lending.
Or they're warning signs. Things to watch out for.
A big one Dalio points to is when you see debt being taken on just to make payments on existing debt, like borrowing more just to cover the interest.
Yeah, that sounds like a red flag. Definitely unsustainable.
Clearly. So what usually triggers the end of the party? Often it's credit growth slowing down or even reversing. Lenders get nervous.
Right.
They tighten standards. And central banks might step in too, raising interest rates to cool things off if they think the economy's overheating.
And that tightening kind of pushes things over the edge.
It can. It either starts the downturn or definitely accelerates it. Makes it much harder for those with a lot of debt to keep up.
And the fallout, I assume, isn't just a quick dip.
No, it's tough. It's not just that getting new loans becomes hard. The pressure to pay back what's already owed gets intense. And as more people struggle, lenders pull back even further. So spending drops, investment drops, incomes fall, asset prices fall. It's a downward spiral.
And that reluctance to lend and spend, it can stick around for a while.
Yeah, absolutely. Even after the immediate crisis seems over, that caution can cast a long shadow over economic growth for years.
Okay, so things are going bad.
Yeah.
What about the policymakers? Central banks, governments, what's their role in all this?
Well, Dalio actually offers a bit of hope here, especially, he says, for countries where the debt is in their own currency.
Okay.
His view is that, most of the time, policymakers actually have the tools they need to manage the crisis, to stop it from becoming a complete catastrophe.
Manage it how? What tools are we talking about?
It boils down to two main things. One, they control their own currency. Two, they can influence how creditors and debtors behave, how they interact.
And that gives them options.
Yeah, significant options. Primarily, it lets them spread the pain out.
Spread the pain.
Right. When a ton of debt goes bad, the total loss can be massive. But policymakers can use fiscal policy, government spending, taxes, and monetary policy, central bank actions to essentially distribute those losses over a much longer period.
So it's not one giant hit all at once.
Exactly. Dalio gives an example, like if the total hit is maybe 16% of GDP, spreading that over 15 years means the economy only has to absorb about 1% of GDP per year. That might be manageable, tolerable. Letting it all hit at once, that would be intolerable, devastating.
Yeah, okay, that makes sense. Gradual adjustment versus sudden collapse. But are there risks? Can the policymakers mess it up?
Oh, definitely. The biggest risks are doing nothing or doing the wrong thing. Maybe they don't understand how bad it is, or they don't have the legal power to act, or sometimes politics gets in the way.
Politics. How so?
Well, the necessary adjustments can be really unpopular. Think about austerity or bailout. Someone always feels like they're getting the short end of the stick. So political resistance can stop policymakers from doing what's economically necessary, even if they know what it is.
Right. So for you listening, understanding these pressures helps make sense of why certain policy choices get made or sometimes not made.
Precisely.
Okay, so we have the basic cycle, the policy levers, but Dalio says not all debt crises are the same, right? He makes distinctions.
Yes. He draws a key distinction between what he calls deflationary depressions and inflationary depressions. The inflationary ones often involve currency crises, too.
Let's start with deflationary depressions. Sounds grim. What defines those?
The main thing is that the focus is on getting rid of debt through defaults, restructuring, and often governments try austerity, cutting spending.
Okay.
But remember, one person's debt is another person's asset. So when you aggressively write down debts, you're also destroying assets on a large scale.
And that kills demand.
Exactly. People, companies, banks, their net worth plummets, so they stop spending.
And you mentioned banks specifically. Why are they so vulnerable?
Leverage. Banks operate on very high leverage. Dalio talks about ratios like, say, 12 to 1, maybe 15 to 1.
Meaning for every dollar of their own money, they've loaned out 12 or 15.
Right. So even a relatively small percentage loss on their loans, say 5 or 10%, can completely wipe out their capital, their buffer. That leads to bank failures.
So in these deflationary situations, what do policymakers typically do?
Well, often the first instinct is austerity, like we said, cut government spending. But that usually makes the contraction worse.
Doesn't sound helpful.
No. So eventually they tend to shift towards other tools, printing money, trying to redistribute wealth somehow to ease the burden on debtors.
But you mentioned they might hesitate.
Yeah, there's often a delay. Public anger about bailing out banks or irresponsible borrowers is intense. And there are legitimate concerns about moral hazard. If you always rescue people, will they just keep taking crazy risks?
The waiting makes it worse.
Generally, yes. The longer they delay stimulus, the deeper and longer the deleveraging tends to be. Eventually, though, you usually get what Dalio calls a beautiful deleveraging, or maybe better termed, a reflationary deleveraging.
Waiting.
Meaning they shift gears, government guarantees for banks, large-scale money printing, quantitative easing, QE, and the central bank buying government debt, essentially monetizing it.
And how well that works determines how long the slump lasts.
Exactly. The speed and the mix of those policies is key. It can mean the difference between a relatively shorter downturn like the U.S. after 2008 versus something really prolonged like the 1930s Great Depression or Japan's lost decades.
What about the really big borrowers? The too big to fail ones?
Yeah, policymakers usually step in there to prevent outright collapse because the systemic risk is too high. This usually involves restructuring their debt, swapping debt for equity, reducing the principal, lowering interest rates, extending the repayment time, sometimes even giving them new loans to keep them afloat.
And recovery from these deflationary episodes. Is it quick?
History suggests not really. Dalio's numbers show equity markets, on average, take nearly 10 years, 119 months to fully recover from the drawdown. GDP takes about 6 years, 72 months.
Wow. That's a long time.
It is. Though interestingly, after all the stimulus and restructuring, the overall debt-to-GDP ratio does tend to fall significantly, maybe by around 54% on average in the cases studied.
Okay, that covers deflationary depressions.
Yeah.
What about the other type, inflationary depressions and currency crises? What's different there?
The key difference is the currency. It starts weakening significantly.
Falling in value against other currencies.
Right. And crucially, it falls faster than interest rates are rising in that country. So holding assets in that currency becomes really unattractive.
Why?
Because the falling value of the currency itself wipes out any potential return from the interest rate. So investors, both foreign and domestic, start selling assets in that currency and moving their money out.
Capital flight.
Exactly. They move to stronger currencies or maybe safe havens like gold.
And that puts the central bank in a tough spot.
A very tough spot. If the economy is already weak because of the debt problems, they can't easily raise interest rates high enough to stop the capital flight without completely crushing the domestic economy.
So they're caught between a rock and a hard place. Tighten credit and kill the economy, or print money and potentially make the currency fall even faster.
Precisely. Dalio stresses this. Managing the inflation growth trade-off is much, much harder when money is flowing out of the country than when it's flowing in.
How do these inflationary situations typically start?
Often, they begin with large inflows of foreign capital. This can fuel a boom, lots of consumption, rising imports, maybe a worsening trade balance.
So initially it looks good again, strong growth.
Yeah, you might see strong growth, rising incomes for a while, but often that foreign money isn't going into productive investments. And if the currency gets too strong because of the inflows, it hurts exports.
And then the tide turns.
Yes. When the capital flows slow down or reverse, asset prices fall, interest rates might spike up, the economy slows, and you can get a debt bust and bank failures, similar to the deflationary scenario, but now compounded by the currency crisis.
What do policymakers do then? Do they try to prop up the currency?
Sometimes, but Dalio advises caution there. Burning through foreign exchange reserves to defend an unsustainable exchange rate often doesn't work long term, and raising interest rates too high can be devastating.
So maybe letting the currency fall is better.
It can actually help sometimes. A weaker currency makes exports cheaper, which can stimulate the economy. It can also make domestic assets look cheap to foreign investors eventually, attracting capital back. It helps the balance of payments adjust.
But surely there are downsides to a falling currency.
Well, absolutely. It's a double-edged sword. The most immediate impact is higher import prices. Everything you buy from abroad costs more. That fuels domestic inflation. And you risk a dangerous spiral. Currency falls, inflation rises. Maybe the central bank prints more money to stimulate growth. Currency falls further, inflation gets worse. It can become self-reinforcing.
And does the money printing even work at that point?
It becomes less effective. If people expect more inflation and currency depreciation, any new money created might just flow straight into buying gold or foreign currency or real estate rather than stimulating lending and spending in the real economy.
So how does it end? How does stability return after an inflationary crisis?
Normalization happens when supply and demand for the currency find a new balance point. This usually requires the central bank to restore confidence, maybe through credible policy changes that make people want to hold the currency again. Also, the economic slowdown itself reduces demand for imports, which helps the trade balance.
And the recovery. Is it faster or slower than the deflationary kind?
It also typically takes years. Investors who got burned are wary. It takes time for the weaker currency to make exports competitive enough and for domestic assets and labor to become cheap enough to attract significant foreign investment again. Dealing with the bad debts is also crucial, just like in the deflationary case.
Can you give us quick historical examples of each?
Sure. For inflationary depression, the classic extreme case is Germany in the early 1920s. Hyperinflation. The currency became almost worthless, prices exploded, it was chaos, partly driven by the attempt to inflate away war debts, a total disaster.
A very cautionary tale.
Oh,
And for deflationary?
the U.S. Great Depression in the 1930s. Started with the stock market crash, which was fueled by lots of borrowing, leverage, then bank runs, defaults. The gold standard limited the Fed's response initially. It took leaving gold, lowering rates, and fiscal stimulus under Roosevelt for things to really turn around, helped by growth eventually outpacing interest rates.
And 2008, that was deflationary too.
Yes, another deflationary one. Housing bubble, easy credit. The Fed maybe missed the asset bubble while focusing on consumer prices. But the policy response this time, TARP, QE, near zero rates from Paulson, Bernanke, Geithner, while controversial, was much faster and more aggressive, which likely prevented a repeat of the 1930s.
Okay, this historical perspective is really useful. So let's bring it home. For our listeners, investors, savers, producers, how can they use this knowledge day to day or looking forward?
Right, this is the practical application. For investors, the big thing is trying to gauge where we might be in a debt cycle. Are asset prices really high compared to history or incomes? Is everyone super bullish? Is there a lot of leverage? Recognizing those potential bubble signs is key for risk management.
So don't get caught up in the euphoria.
Exactly. Also, understand the policy tools. What are central banks likely to do? How might higher rates or QE or regulation affect different assets? You need to think about protecting yourself against both deflation falling asset prices and inflation, your returns getting eaten away by currency devaluation. Dalio suggests certain real assets might perform better when debt is high and real rates are low.
Makes sense. What about for savers? People just trying to protect their nest egg.
Well, for savers, it really underscores the basics. Save consistently and be very wary of taking on too much debt yourself. Understand that inflation, especially the kind you see in those inflationary crises, can severely erode the value of your cash savings.
So maybe don't just keep everything in a standard savings account.
It suggests considering diversification. And paying attention to the health of your bank is important too. Thinking about deposit insurance limits, maybe even considering holding some savings and assets that might protect against inflation, or in stronger foreign currencies if you see serious risks domestically.
Okay. And finally, for producers, businesses making things, providing services.
For producers, it's about understanding how these cycles hit demand. A downturn means less spending, potentially tighter credit for your own investments. Currency swings are also huge.
How so?
Well, if your currency weakens, your exports become cheaper, which is good, but your imported materials become more expensive, which hurts margins. If your currency strengthens, it's the reverse. So managing that currency risk is vital. Also, be aware of potential government actions during crises, tariffs, subsidies. They can change the playing field quickly.
So if you rely on imports and your currency looks shaky, you need a plan for rising costs.
Absolutely. It's about anticipating these shifts based on the cycle dynamics.
So the bottom line seems to be that these patterns Dalio identified, they aren't just academic. They offer a real framework for thinking about risk and opportunity for pretty much everyone involved in the economy.
That's the core message. History doesn't repeat exactly, but these dynamics of debt, income, assets, and policy responses, they rhyme very strongly. Recognizing the patterns gives you an edge.
This has been incredibly helpful, really unpacking a complex topic. So just to recap the main points, understanding how these big debt cycles work, the typical stages, the policy responses we usually see, and learning from history, all this gives you, whether you're investing, saving, or producing, a much better toolkit for making decisions.
And recognizing that tension, between the short-term pain needed for adjustment and the goal of long-term stability that's critical for interpreting what's happening during a crisis.
Right. Which leads us to a final thought for you to chew on. Given everything we've discussed these historical cycles, the policy options, what specific things will you be watching now? What indicators will help you assess the current economic climate and make smart choices for your future in whatever role you play?
Yeah, think about it. Where do we stand today with debt levels relative to income? What about asset valuations? Are you seeing any of those classic warning signs Dalio highlights in the current environment? And if so, what does that imply for your own financial strategy?
Definitely something to consider. If you want to go deeper, Dalio's book, Principles for Navigating Big Debt Crises, is the source. Or you could research some of the specific crises we touched on. Understanding the past really can help prepare for the future. Thanks for joining us for this deep dive.